Okay, sounds good. Good morning, everyone. Thank you, Carol. So I'm looking at a non-amended copy of the minutes, but I'm hoping it's the same. I didn't get an amended one unless I missed it. So I'm gonna go ahead and read off of the non-amended one in front of me. So I'm gonna go ahead and call to order the Friday, May 8th, 2020 Retirement System Board of Trustees meeting, called to order at 8:04 a.m. One is public comment. I've been told that there is none. Two is request that the board approve the agenda for May 8th, 2020. Is there a motion?
So move.
I'll support.
All in favor? Aye.
Aye.
Any opposed? For three is request that the board approve the minutes for April 14th, 2020. Is there a motion?
So moved.
I'll second the motion. All in favor? Aye.
Aye.
Any opposed? Four is request that the board consider adjustments, applications for benefits as follows. There are no adjustments. Applications: Constance M. Joswick, formerly of the Police Department, ROPOA bargaining unit, 19 years and 3 months of service credit. Deferred retirement requested. Request for a retirement date of May 31st, 2020. Eligible based upon terms of a special agreement. Craig T. Strauss of the Fire Department, Fire Local 431, bargaining unit, 25 years and 7 months. He purchased 3 years of service credit. Request for a retirement date of June 18th, 2020. Eligible based on years of service and age. There are no benefits at this time. Is there a motion to approve the adjustments and applications as listed?
Move.
Was that support from Kyle? All in favor? Aye.
Aye.
Any opposed? Investments, I will turn it over to Terry.
Hey,
Lee,
good morning, everybody.
Terry, sorry to jump in. Lee, if we could go back for a second. The amended agenda item does include an additional retirement application.
Okay, you know what? I apologize. I see that on the screen now. So we'll go ahead and Andrew Isidoric of the Police Department, ROPO, a bargaining unit, 25 years, purchased. I can't quite see the amount, but let me see if I can. So he purchased 5 years.
5 months.
Okay, 5 months of service credit. Request for a retirement date of May 25th, 2020. Eligible based on years of service. Is there a motion to approve?
I'll move to approve that application.
Thank you. Is there a second? I'll second it. All in favor?
Aye.
Aye.
Opposed? So we can turn it over to Terry now for investments.
Okay, thank you, and good morning, everybody. Hope everybody continues to stay well. If we go to page 4, obviously it's just a relatively abbreviated presentation this morning. We're just updating on the month of April. So if you go to page 4 of the book, I don't know if, I hope you all have it in front of you in one form or another, or can we bring it up on the screen? Anybody not have it? Oh, there we go. Oh, maybe not. Carol?
Terry, I don't have it, so I can't.
Okay, does everybody have a copy?
Do you want me to make you a co-host so you can share it?
Yeah, let's see. I could, yeah, we could try that. Does everybody need to see it on the screen? Do you have copies? Anybody not have copies? Everyone has copies? I think we're good. Okay, so page 4, if you would. You can see the asset allocation as of the end of April. And of course, the balance there is now $140.5 million. You can see just by the allocations versus target, we're now a little overweight equities because of the rebound that we've seen since we rebalanced at the end of March, but that's actually a good sign to see that up the way it is. If we go to page 5, you can see the flows and the performance. Let's start at the bottom of the slide first. You can see for April, we began the month at $134.8 million. We had net cash flows out of $2.2 million to pay benefits. And we had a gain, though, of 7.875, almost $7.9 million, getting the total back up to $140,508,693. So nice rebound in the markets since we last spoke. And as I mentioned at the last meeting, expect volatility to continue here. This will not be a straight line up, but we're at least seeing preliminary signs of the markets pricing in the worst, and starting to look ahead to 2021, where the economy hopefully will be better and the markets will hang in. So it was an encouraging month. We're not calling the bottom. We wouldn't be surprised if we retested along the way, but much of that will be dependent, of course, on the progress that we all make throughout the country in terms of coronavirus infection rates. But as you can see at the top of the slide for the month, the total portfolio was up about 6%, was behind the benchmark. Primary reason for that was structured credit. And we'll talk about that in a second. You may recall that structured credit, as other alternative investments, are priced on a 1-month lag. So last time when we were reviewing performance, we were actually looking at February performance. Now we have March performance where it took a hit in the flight to safety. But it's now up again in April. We'll see that at the next report. If we go to the following slide, page 6, again, you see the total portfolio return for the month. Hold on, I just lost it on my screen, so I apologize. I've lost it completely. You have to bear with me 1 second. I've got a technical glitch on my end here now, but I'll get that right back. Okay, so if you look at page 6, again, the month performance, you can see that on a year-to-date basis, now down 9%, but obviously a lot better than the double-digit declines that we saw earlier, clawing back some of that performance here in April. The rebound you can really see in equities in the green line there for total equities, up 11.6% for the month. Large cap was up 12.9%. It was really small cap, which had been hurt particularly hard in the month of March, as investors were selling everything they could to buy treasuries. The small cap market being less liquid was hit even harder than the broad market. But now a nice rebound as trading conditions have normalized, up 15.65% for the month. So that was good to see that type of recovery. In the non-US markets, up strongly, not as strong as the US, but up strongly, 28.4%. And it really being led by the developed international markets, the emerging markets still relatively weak, although, I'm sorry, I'm looking at I apologize. The world equity was up 9.27%, total international portfolio, and about evenly divided, with world equity developed and emerging up 9.1%, and emerging markets up 10%. I apologize for that. Fixed income, as you can see, not the big rebound that we had in equities, not surprising, but up a solid 2.7%. Core fixed income had a very nice recovery in the month as credit instruments and non-treasury securities in particular rebounded significantly. As you can see, core fixed income well ahead of its benchmark, which was actually down 1.8%. So Treasuries started to sell off a little bit in April after the flight to safety in March. So it was really the non-Treasury sector, of the fixed income portfolio that did particularly well, giving us a good positive performance. Emerging market debt and high yield bonds both similarly rebounding. Emerging market debt up 3.1% for the month, and high yield bonds up 2.2%. Obviously, both are still down double digit since the beginning of the year. We're starting to see that recovery, and these markets starting to act more like the equity markets. Core property hanging in at 1%, but that is not updated. That's for April. That's priced on a quarterly basis. So you're really seeing the last 3 months return there, but we'll have updated numbers at the next meeting for the report on. Structured credit, you can see that's where the hit occurred. And again, that's really reflecting March performance, down 31.7%. This is an illiquid area of the market. And so when investors are trying to sell in a dislocated market and where not operating smoothly, you tend to see the more illiquid securities be priced at a significant discount to underlying value, as investors are in some cases forced to sell, and there aren't buyers on the other side. We saw this happen in 2008. In fact, I've got the numbers there. It was interesting. 2008, there was a paper loss of 62%, but it wasn't a real underlying loss. And in 2009, that fund was up 189%. So it moves around quite a bit when trading conditions are illiquid the way they were in March. But we're starting to see the rebound already. It's up about 5-6% in April, and we expect that progress to continue. But it did, at least on a mark-to-market basis, did impact the month as we reflected the frozen fixed income market that occurred in March. As I mentioned at the last meeting, trading conditions are much better, much more normal now in the broad fixed income market, as the Fed has intervened with a variety of policies and programs designed to ensure that trading can occur in these markets on a somewhat normal basis. They've been actually buying up not only Treasury securities, but they've implemented a number of other programs to buy credit instruments, money market instruments, all in an attempt to restore normal liquidity to the markets, and looks like they've been largely successful. Part of the reason we've seen a nice rebound overall in the market is that investors are increasingly confident that the Fed will do whatever is necessary to maintain normality in the markets while we undergo this pandemic. So that's it. I mean, it's really it's just 1 month. Obviously, economically, there's not a lot to report that you don't already know. We've seen the unemployment numbers. We're seeing dramatic increases in unemployment, not surprisingly, with the lockdowns, and that will continue here for a while. With very elevated levels of unemployment as we go through the next few months. But importantly, the markets are looking at discounted and priced in, I should say, a lot of that current bad news, and looking ahead to a better 2021. And so we're starting to benefit from that in the portfolio, as you can see by the 1 month number. And hopefully that will continue over the next few months. Questions?
I don't have any questions. Thank you, Terry.
Okay, thank you.
There's no other questions. I'm going to go ahead and make a motion to receive and file. Second by Brett, I believe. Or second by Brett. All in favor? Aye.
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 Any opposed? All right, thank you. Tom, did you have anything under legal?
Mr. Chairman, if I could have you receive and file the first item, Robbins Geller report, please.
I'll make the motion to receive and file. Is there a second?
Support.
All in favor? Aye.
Aye.
Any opposed?
Thank you. The second item has to do with a memo we put together regarding the Secure Act. It deals specifically for this plan with IRS rules. I'll spare you the specific details of the regulations. Just suffice it to say that they're building in some additional flexibility. And as part of someone's retirement, when an individual receives a distribution, they should get a notice that provides them, not with tax advice, but provides them with some reminder of the IRS guidelines. We've attached in that memo an updated notification. We refer to it as a 402 notice. That's the IRS section 402 that requires you to hand this out. A recommendation would be is to receive and file the memo, as well as to utilize the attached sample notice going forward, which would be then compliant with the code. I'd be happy to answer any specific questions you have on the IRS, but I wouldn't be surprised if no one had any. Thank you.
Sounds good. Thank you. Motion. I'll go ahead and make the motion to receive and file. Is there a second?
Second.
Second by Brett. All in favor?
Aye.
Any opposed?
Thank you very much.
Thank you. Julie, did you have anything under other?
No, thank you.
Okay, thank you. Let's go ahead and try to set the date for the next meeting then. We're looking at Monday, June 1st, 8 a.m.
I am available for that day, but we will not have performance for May that early. We're going to need at least a week.
The following week, Monday, would it be the 8th?
That would be better.
Yeah.
Good.
Is that a commission meeting?
Yeah, there will be a commission meeting that night.
That is a commission meeting, and it's, if I can just say, it is kind of tough for us to be here at 7 a.m. not knowing how late we'll be here for a city commission meeting.
I understand that with, I mean, obviously, I guess should we just have the meeting without the new numbers? And stick with the proposed date, or?
What about Tuesday night?
I think the day after a late meeting is equally difficult at times.
Any other day that week?
I'm open.
About the 12th.
Let me check if I can go to stop sharing. We do have the planning commission and zoning meeting. Let me just check that because they are the second week in June.
Yeah, those will probably be the 9th and the 11th.
Wednesday, June 3rd, 8 a.m. Good, thumbs up.
Sounds good.
June 3rd. Okay.
Are we gonna have numbers the third?
Well, that's I'm sitting here thinking it might be a little tight. I can't guarantee it. I can check, but
Thursday the 4th, Friday the 5th.
Friday the 5th for sure, for sure.
Okay.
That looks good.
Friday, June 5th. Everybody?
Thank you.
Dave was correct. Planning commission is June 9th and June 11th. So your June 5th date would work very well in the schedule.
Is Julie available? I see connecting. If we could get a confirmation from her.
Yes,
Good with
I'm
Friday,
here by phone.
Friday, June 5th?
That'll work. Thank you.
Perfect. Friday, June 5th, 8 a.m.
Okay, thank you all.
All right, thank you, Terry. Motion to adjourn, please.
Move.
Support?
Support.
All in favor? Aye.
Aye.
Opposed? All right, thank you, everyone. Carol, still good with just rolling on through? Staying on the channel?
Lee, could you announce the adjourning time, please?
Adjourned at 8:24 a.m. on 5/8.
Thank you.
Thank you.
I did just make it one URL this time, so you didn't have to log off and log on, my learning curve. And I do have the agenda available. I don't know if you want to wait until the actual 8:30 time.
No public comment on this one as well, correct?
Correct. No public comment.
Okay, I don't feel the need to wait the few minutes. It's scheduled Friday, or I mean, it's to follow the other meeting. So I'm gonna go ahead and call to order Friday, May 8th. (8:25 a.m.) Retiree Healthcare Investment Board meeting. Number 1 is public comment. There is none. Number 2 is request that the board approve the agenda for May 8th, 2020. I'll go ahead and make the motion. Is there support?
Support.
All in favor? Aye.
Aye.
Opposed? 3 is request that the board approve the minutes for April 14th, 2020. I'll go ahead and make the motion. Is there support?
Support.
All in favor? Aye.
Aye.
Any opposed? At this time, I'm going to turn the meeting over to Brian for investments. Do we have Brian?
He's muted.
Can you guys hear me?
Now we can.
Okay. Carol, can we do screen share?
I was sharing the agenda. I don't have the attachments to share.
If you're willing to make me co-host, I have no problem sharing my screen.
100%. There you go.
All right, so here we go. So this is a very different conversation about recent results today than it was a couple weeks ago and definitely a month ago. As I'm sure you've heard from the retirement system side of things, April was one heck of a rebound in the equity markets. These are easier numbers to deliver, but it was a recovery off some pretty dramatic lows. So we are still in negative territory on a calendar year-to-date basis, but we certainly saw a lot of recovery, particularly in the U.S. markets. S&P 500 up 12.8%, mid-cap stocks up north of 14, small-cap stocks up 13.7. International stocks were a bit more mixed, a bit more muted, still in positive territory. But for example, developed markets were up about 6.5%, and emerging markets fared a little better, up over 9%. You also saw continued gains as rates drove lower and lower and lower from a fixed income standpoint. High quality U.S. fixed income was up about 1.8%. And then those sectors hardest hit here in the U.S. and the fixed income world, things like corporate investment grade bonds, were up just over 5% for the month, still in negative territory in the last 3 months, but positive for the year. And then high yield bonds up about 4.5% for the month, but still in negative territory on a year-to-date basis. Not a big surprise if you look at things on a sector basis, bottom left-hand corner of the market commentary page. The best performing sectors continue to be, I think, those areas we're using the most: information technology, Zoom, and the like, healthcare, and consumer discretionary. And a lot of consumer discretionary will fall. You'll see Grubhub and different delivery services are obviously faring pretty well through this pandemic. Last piece I'll leave you with here, rates have moved lower across the board. Again, not a big surprise. We're back to a zero interest rate policy, at least on a short-term basis. But it's amazing when you look at some of these numbers and realize, you could do a 10-year treasury at 0.64%, a 30-year treasury at just shy of 1.3%. I'll tell you the one thing that has stayed kind of stubbornly at that same level is long-term mortgages. We've kind of seen a floor put in place on an anecdotal basis from a personal standpoint. One of my cousins is a realtor out on the west side, and she was pretty happy to be able to go back to work, on a different basis, but no longer doing necessarily virtual showings. But one thing she and I were talking about that was surprising is the fact that despite the floor absolutely dropping out in long-term U.S. Treasury rates, and traditionally a 30-year, 15-year or 30-year mortgage is based off of the 10-year Treasury. There's really been a floor put in place because the banks don't want to lend money for 30 years at anything less than 3.25% to 3.5%. So we aren't necessarily seeing the same impact from a mortgage interest rate standpoint that we've seen from a long-term U.S. Treasury standpoint. A couple of things to walk you through. So, first quarter obviously was still positive from an economic standpoint because this really didn't set in until late February and into March. So first quarter numbers aren't really going to necessarily see, I haven't seen that impact yet, but the estimates are first quarter to decline by 4.8%. The traditional historical definition of a recession was 2 consecutive quarters of negative GDP growth. It's interesting that the National Bureau for Economic Research has come out and clarified that and has said it's really any period of decline. So we can kind of call it. If this is only, 4 months of contraction, we can still call it a recession. It doesn't have to be 2 consecutive quarters. But we did finally see things tip over. So you can officially call the end of this most recent economic expansion that had been the longest in post-World War II history. One quick piece just from an educational standpoint we wanted to walk you through. So we're implementing one change in the portfolio. We're going to be reducing some of the exposure we have to that Templeton Global Bond Fund in favor of increasing and adding exposure to a dedicated high yield allocation. So if you recall a while back when we were revising the IPS, one of the provisions that's in there is the availability of having an allocation to high yield bonds or pieces of the U.S. fixed income market that are below investment grade. The statutory limit, the 314 limit, is 15%. The limit on your investment policy statement is a maximum of 7.5%. So we're going to be implementing here in the next day or two a 4 to 5% position. And to give you an idea of what we're talking about is it's adding a strategy that's investing in securities that are rated below investment grade. So if you think about the traditional investment grade ratings, that's going to be things that are rated BBB or higher. Single A, double A, triple A. What we're investing in or what these strategies are going to invest in are those rated BB or lower. You can call them high yield bonds, you can call them junk bonds, you can call them below investment grade, depending on how you're feeling on any given day. Now, while this is a very broad range of allowable credit ratings, the strategies that we traditionally allocate to have an average credit rating. So you take the investment grade rating of all of the underlying securities in the portfolio that rank up here in BB. So it's not that they're investing in these really, really poorly rated securities. It's they're investing in securities that kind of fall in that high B and into BB category. So kind of the first rung down into the investment grade landscape because they think that there's the best opportunity. Those are traditionally companies that have had some type of misstep. Going through pandemic, right? Sales are off, revenue's off. They get downgraded from an investment standpoint, but the underlying business and the products they're making and the services they're delivering are still there. It's just a short-term anomaly has impacted them. The term there is fallen angels. They've fallen from being investment grade down to being below investment grade. Those are actually the most likely to improve and to be upgraded from below investment grade into investment grade. And here's why. So this is a chart from the Federal Reserve. And there's two things we're measuring here. So the blue squiggly line that you see that has more muted movement is what's called the option adjusted spread. So when we operate in the fixed income world, everything we hear talked about is a spread over treasuries. And it basically says, right, treasuries are arguably are viewed to be the risk-free rate, right? Take all the politics out of it, but if I buy a 10-year treasury or a 2-year treasury or a 30-year treasury, I have the utmost of confidence that I'm going to get repaid. So that becomes the benchmark rate. So if a 10-year treasury is trading at 0.6%, and I can buy a bond that's paying 5.6%, so 5% more, that's a spread of 5 over, or 500 over. So what we're measuring here in this blue line is the spread of high yield over treasuries. And as this line moves higher, the higher movement in the line indicates the market saying, okay, there's something going on out there where I need a greater compensation for the risk I'm taking in buying high yield bonds. So I'm going to go from being paid 3 to 4% over treasuries to being paid 8% over treasuries or 10% over treasuries. And these typically tie out to periods of market crisis, either from an economic standpoint or the stock markets are trading off. So you can go back and see this happen, late 16 into 2017, back in 2012. And most recently with this spike, you've seen the spread or the compensation you earn for owning high yield instead of owning treasuries actually hit 11%, which is a high in the last 6 or 7 years. The last time it was at that level was back in 2007, 2008. Now, what's important here is the correlation and the connection between the blue line and the red line. So the blue line is at this point in time in the market, this is the spread. This is the compensation I need to earn over treasuries. This red line is the 1-year performance of the high yield bond index. And these peaks correlate to each other. So when high yield spreads widened, you hear the term blew out if you listen to or watch CNBC or MSNBC or whatnot. But when they widened in early 2016, that was the market saying, no. Something's going on. We need more compensation for this risk. Well, at that point in time, the return for the year, right? So the 1 year ended first quarter 2016. If you owned high yield bonds at that particular point in time, if you looked at the 1 year column on your performance report, that return would be about negative 12%. So spreads widened out. The market said, we need more compensation for this risk. Prices declined. We don't own this in the portfolio. So if that was your entry point, was this point where spreads were at their widest or at a historical wide, 1 year later, the return on your high yield portfolio was 25%. You go back to fall, winter of 2011, spreads widened out to about 9%. Your return at that point in time, if you looked at your report for the most recent year, was negative 3%. But a year later, your return was about 21 or 22%. So from a historical standpoint, when we see spreads hit this 7 to 8% level, it's a good time to enter high yield. It's a bad time to sell it. It's a good time to buy it. We don't own it in the portfolio because we've been waiting for an opportunity. We've been in this environment of high yield bonds, really just not compensating you for the risk. We now believe we're being compensated for the risk in high yield. So you're going to get a memo late next week detailing the strategy that we added. It's going to go in on Monday. But we believe, based on what we've seen from a historical standpoint, this is a really attractive point to add some high yield exposure to the portfolio based on this historical relationship, right? When spreads hit these levels, you wish you didn't own it. But when spreads hit these levels from a historical standpoint, you really wish you would have bought it. So we don't own it. We're going to buy it. And it'll be about a 4 to 5% allocation. Remember, the max is 7.5. So we do a 5% allocation because to the extent what we believe will happen does, it gives us some room to allow that to grow and trim it back and trim it back and trim it back so we can make sure we stay in compliance. Mountain chart here, we go back to the original value, 105 million back in April of 17. If you looked at this chart as of March 31st, this number here was 0, just because of the impact of the market pullback in late February and into March. We're now in positive territory as far as the overall experience. gain of about $8.8 million over the investment life of this retiree healthcare trust. Talk a little bit about April. Again, as we've mentioned, at that first page, really, really strong gains across the board. No surprise. We went from $115 million in market value, paid out $1.1 million in healthcare premiums. Market gain, just over $8.7 million to close the month of April at $122.8 million. So strong gains across the board. Obviously, the biggest portion of that gain 8.3 of that 8.7 came out of your equity portfolio. To a lesser degree, gains we saw about $400,000 out of fixed income. Most of that obviously came from Baird. Nothing yet out of real estate because that updates on a quarterly basis. So let's go to the results. What worked, what didn't. For the month, we were up 7.7%, right in line with the policy index that was up 771. On a calendar year-to-date basis, we've gone from being down double digits to now being down high single digits, down just over 9% versus the policy index that was down 7.8. And really the key here, that obviously the best performance, no surprises, Vanguard Institutional Index Fund just replicates the S&P 500. AQR, that more defensive portfolio, did really well in February and March. We're still up north of 10% for the month, but obviously lags because of its more defensive posturing. Sizer was the best performer on an absolute basis, up 13.6 versus their benchmark that was up 14.4. Thalen and core Thalen portfolio with a little bit more of a value bias to it, up 11.3. They've been most impacted in their portfolio. Then a little bit of an overweight. When I say overweight, the index is 5%, they were 7%. It wasn't a 15 or 20% allocation, but they've had more exposure to hospitality and leisure in here. One of the stocks we've seen in both of these portfolios, for example, is Expedia. If you've done something on Travelocity, Expedia, carrental.com, Cheap Fares, VRBO, or HomeAway, you're an Expedia customer. And obviously, with travel being at a near standstill, those stocks have been pretty hard hit. Expedia has actually gone through a pretty big shuffle, new CEO, a handful of restructurings. They raised $3.2 billion in debt, so they're actually pretty well positioned. It's funny that that's a travel company, but all of their revenue is based on bookings, right? They earn a fee based on travel being booked. So from an infrastructure standpoint, there isn't a lot there from a cost. It's really just a software development company. International equity was one of the better performing parts of the portfolio versus benchmarks. You see both First Eagle and Bontable ahead of their benchmark, as well as the Transamerica portfolio. On a year-to-date basis, First Eagle hanging in there the best, more conservatively positioned, a little bit more cash in the portfolio, a little bit of a gold allocation, only down 11% so far this year versus benchmark down about 17.6. Bontable, that is our growth-oriented portfolio. Growth stocks have really led the way so far this year again, down 12. And then Transamerica down about 15%, about a percent ahead of their benchmark. Shift over from a fixed income and real estate standpoint. Baird, that had struggled in the first quarter because they have more exposure to corporate investment grade bonds. And frankly, if you owned anything other than treasury bonds and agency bonds, you lagged a little bit this year. Great month, up just over 2%. Templeton, because they have little to no exposure to U.S. interest rates, continues to lag. We've seen them go through periods of underperformance like this, and we'll see them snap back in a quarter or two. And then finally, Prisa. This would have been updated after we did the March 31st update. That's our core plus real estate portfolio, up 1.2% so far this year versus benchmark that's basically up 1%. We have spent, interestingly enough, a lot more time tearing apart real estate portfolios. Right, the traditional equity markets and fixed income markets are leading indicators, right? So markets traded off in February and March based on market news, based on impact from a recession standpoint, based on the impact of the virus. Real estate markets are still in positive territory. So the expectation is we traditionally see a 6 to 9 month lag for an impact on real estate. So we're spending a lot of time focusing on strategies that have exposure to things like retail, hospitality, to understand how much they're collecting in rents and how they're doing there PRISA thankfully has a very, very low exposure to things like hotels and hospitality. And any of the retail exposure that they have is either what they refer to as experiential, meaning it's surrounded by office buildings and apartment buildings. So from a millennial standpoint, the desire is to live, work, and play in the same spot in major metropolitan areas. Those have largely been unimpacted because they're anchored by things like a Whole Foods or a significant amount of other grocery tenants. The other piece that they have where they do have kind of traditional retail exposure is those power centers you'd expect to do well. It's the Kroger next to the Ace Hardware, with a number of then smaller shops, nail salons, things like that next to it. But where we've talked to a lot of those property owners, they're still collecting 85 to 90% of their rent because their major tenants are the grocery stores or a hardware center that are still open and doing business and still able to pay rent. But those smaller kind of mom and pop operations, restaurants, nail salons, floral shops, all of those traditional kind of ancillary businesses you see in those strip centers are obviously struggling through this. So good month, nice recovery from an overall basis. Where we've seen a little bit of underperformance, we aren't overly surprised. One change you're going to see here in the next couple of days, as we've mentioned, to the portfolio. But outside of that, I'll pause and see if there's any questions.
I don't have any questions. It was a good presentation, Brian. I appreciate it. I appreciate the proactivity too. So it was good. Anyone else have any questions for Brian? Anything you want to add, Brian?
Only that Brett's background is the best out of any that I see.
I
Yeah,
agree.
because of the pandemic, I had to learn to do my own taxidermy. I just finished that a couple days ago.
Look at this guy.
Yeah,
Feel like an underachiever all of a sudden.
yeah, I used to pay for these.
Everybody else has learned how to bake bread or play the guitar.
Right? TikTok. All right, sounds good. I'm gonna go ahead and make a motion to receive and file. Can I get support? Support by Brett. All in favor? Aye.
Aye.
Any opposed? Under legal, Tom, anything to add?
No, all set. Be
All
well.
right,
Thank you.
Nothing under legal. Julie, anything under other on this one?
No, thank you.
All right, thank you. The date of the next meeting has been set. I will go ahead and make a motion to adjourn.
Support.
Support by Kyle. All in favor? Aye.
Bye.
Any
Aye.
opposed? Lisa, that's adjourned at 8:47 a.m.
Thank you.
All right, thank you, everyone.
Thanks all. Be well.
Bye.
Thanks, everybody.
Thank you.